think we do have people already joining in. So anyway, today's topic is Scope 3. So I don't want to spend more time waiting. So maybe we can kick it off. Uh, so yeah, thank you everyone for joining in. Today, as you know that it is kind of like the fifth session of this entire workshop that we are running we started with BRSR and then kind of like we also started delving deeper into each and every topic. So today's topic is going to be mainly about Scope 3 accounting for any company. So that is what we are going to focus on. So I'll just maybe take a couple of minutes again, briefly talking about Oren. So as you would have heard about it when you joined earlier in the earlier sessions, that Oren is a niche tech consulting firm. You can think of it that way. We have two verticals. One vertical primarily looks after the technology transformation part. So we do have our own Oren Sustainability Hub as a platform, which enables any client or any company to kind of ease out through the data management to reporting process. And apart from this, we do also have our entire expertise team who helps companies or clients throughout their journey in the environment, social and governance or sustainability journey. So you can see marquee clients already on the screen, right? So we do all work with global clients, not only limited to India. And in the last couple of years, we have been awarded for our technology advancements as well as the entire performance of our um, advisory and consulting team. So those are already there on the screen, right? Now, without spending any more time, I'd like to introduce Olivia. If you would have attended all the sessions earlier, you would be already aware of Olivia. So she has already taken one more session on scope and scope 2 accounting or carbon emission and energy, right? So Olivia has been part of Oren team for quite some time now. And from her background, she's already she has done her master's in sustainability from XIMBA University. And then she has spent enough time in the corporate space as a consultant or as a individual participant to kind of help corporates through the sustainability journey. And again, specific to carbon accounting, GHG, all of these things are something that she has been doing in and out. So yeah, like that is what Olivia is today going to present about Scope 3. Over to you, Olivia.
Perfect. Sounds good. Thank you so much, Abhirup, for the introduction. So as for a couple of you, we've already met. For the new joiners who have joined us, start with the session on Scope 3. So here we are going to understand why is Scope 3 really important for your accounting. And we are going to look at the upstream and downstream emissions under Scope 3. We are going to explore some key concepts with respect to Scope 3, how we do the accounting, what are the key methods followed, and what are the calculation approaches. We are going to deep dive into the 15 specific categories of Scope 3 spread across upstream and downstream. Then we are also going to look at a case example, and then I will ask a few questions to all of you so that we understand as we go. And lastly, we are going to address a couple of challenges which we face while we do our Scope 3 accounting. So moving on, why is Scope 3 emissions important for a company to measure? So this is a very common question, and to answer that, Scope 3 accounts for the most largest proportion of our total GHG emissions. If we look at real estate, construction, and automobile sectors, those sectors have a lot of Scope 3 emissions. But however, if we look at some sectors like cement or say electric utilities, those companies will have a little bit less amount of contribution to their Scope 3 emissions, maybe 60 to 70%. But on an average, it has been seen, and it is a fact that almost 70 to 90% of your total greenhouse gases emissions come from your Scope 3 accounting. So it is really important to start measuring and accounting for it, as it represents the largest share of your total total GHG emissions. Then another thing is that it is really important because if you're going for your science-based target settings, it is a mandate. You have to have your Scope 3 accounting in place and to set your science-based targets. And also for your net zero targets, while you're doing your calculations, you have to account for scope 1, 2, as well as your scope 3 to get the entire picture, and you will set your net zero target accordingly. Then the third thing is that it builds supply chain resilience. As you are doing your supply chain scope 3 accounting, you identify key suppliers in your value chain who are of higher risk. Maybe you can not include those vendors in your list, or you can deselect them if you want, because of their huge emissions. So it builds resilience in your supply chain. And finally, it enhances your ESG reporting. As you are accounting for your scope 3, you are strategizing your emissions in such a manner, and you are also doing a transparent reporting and contributing to a good report. Moving on, here I've mentioned the sector specific relevance of scope 3. And as you can see, in most of the sectors, scope 3 accounts for a huge chunk of emissions. The orange color which you can see is your scope 3. So as you can see, in capital goods, in cement, in chemicals, in coals, construction, electric utilities, all these have a huge chunk of the emissions coming from your scope 3. So it is really important to measure your scope 3. So here we are going to look at the standards which allow us to perform our scope 3 calculations. So as per GHG protocol, we have 3 standards. The first is your corporate standard, which guides you on your calculation for scope 1, 2, and 3. Your corporate value chain standard, which is also called as the scope 3 standard, which is your main document which you look for when you're going to do your scope 3 accounting. And here we are going to focus on this. And then lastly is your LCA standard, your product life cycle, so that you understand what are the key hotspots in your product, and you can reduce your emissions in your product phase. But here in this webinar, we are going to look at the corporate standard, the scope 3. So to understand what is upstream and downstream emissions, as I mentioned, in scope 3, you have upstream and downstream. So upstream basically means all the emissions coming from when your product, before your product reaches to the factory, all the emissions occurring from that phase. And when your product is finished and is completed in your factory and it goes out for your distribution, that comes under your downstream emissions. And it includes your distribution phase, your use phase, your disposal, how are you treating it, everything comes under your downstream. In upstream, everything is with respect to your raw material extraction, your transportation of the raw material to the warehouse, all those things comes under your upstream category. Yes, so moving on. Here I mentioned the categories specific to upstream and downstream emissions. In upstream, you have purchase goods and services, you have capital goods, you have fuel and energy related emissions, which are not included in your scope 1 and 2. Fourth is your upstream transportation and distribution. Fifth is your waste generated in operations. Sixth is your business travel. Seventh is employee commuting. And in downstream, you have downstream transportation and distribution, and processing of sold products, use of sold products, end of life of treatment of sold products, downstream leased assets, franchisees, and investments. I will deep dive into each of these categories as we move ahead in the webinar. So I've listed the steps which we follow when we calculate our scope 3 emissions. The first thing we do is identify the relevant scope 3 categories. We also call it the scope 3 screening. First, we need to see what categories are relevant to our company and to our sector, because all the categories will not be applicable and will not be material to us. So this step is a very crucial and important step. The second thing after identifying your relevant scope 3 categories is that you collect your activity data. Now, how are you going to collect your activity data? This also depends on what methodology you're going to follow for calculating your emissions. So if you're going to go ahead with a spend-based approach or a financial-based approach, then you will have to get your data from your enterprise risk program system, ERP systems. Like if you have SAP or Oracle in your company, you will take it from there, your financial data. If you are going ahead with your activity-based approach, then you are going to engage your value chain partners and your suppliers to get their data. Because we would require to collect the data from your suppliers. The third approach is a hybrid approach, in which you are incorporating both the spend-based approach as well as your activity-based approach. Here you can use both the methods for your calculation. Then the third thing is that you select your appropriate emission factor from credible sources. Either you can go for DEFRA or you can go for IPCC, GHG protocol, US EPA. All these websites are good for getting your emission factors. Then finally, after calculating it, you consolidate it by summing your entire calculation. So this was your steps while you calculate your scope 3 emissions. Now, since the first step is to select your relevant scope 3 categories, so how are you going to proceed with that? And this also this is not that you just have to follow one method. You can use a combination of these three methods, which I've listed down here. First is a quick screening. Either you can look at your sector-specific guidelines from CDP, from SBTI or GHG protocol technical guidance, which has a clear defined relevant scope 3 categories for your sector. Then either that, or you can do a peer analysis where you will look at your peers GHG report or ESG report, where they have disclosed their listed scope 3 categories, and you can perform a benchmarking activity and select the relevant categories for your company. The second is based on the financial spend. So here we calculate the emissions based on your spend on your records, the spends in your records. So here the assumption is that higher spend or higher revenue indicates larger GHG emission. However, it is not always that the case. We always need to verify it with the emission relevance. The third is your multi-criteria analysis, which is a detailed analysis of selecting your scope 3 categories. It includes a lot of categories, and you can add on to this list. You can prioritize your categories based on the influence it has over the emissions, your climate risk exposure, your stakeholder demands, and whatever other, if there are any other criteria, you can add on to the list. This gives you a clearer picture and is a preferred method for your selection of scope 3 categories. So this is just a screenshot I've taken from CDP. This, as I mentioned, the first way of quick screening is looking into sector-specific guidance for your scope 3 categories. So this is for steel sector. Relevant categories are purchased goods and services, capital goods, fuel, category 3, fuel and energy-related emissions, upstream, transportation distribution, waste generated in operation, employee commuting, business travels. Downstream emissions are a little limited. to steel sector. You can find all the sector relevance in CDP, and you can find your relevant category. Here I've also given an example of a financial service sector. So here your purchase goods and services is also of importance. Then there is business travel and employee commuting, which happens a lot in banking sector. So that is why as you can see, the percentage is higher for those two categories. So this is how you can screen your scope 3 categories in a quick way, in a very easy manner. Now, moving on to calculation approaches for your scope 3 categories. As I mentioned, there are three basic approaches of going ahead with it. You can go ahead with a spend-based approach, where you are, and when are you going to use this? When you have limited amount of data, and it is the most easiest way of calculating your emissions, because you just have your all the financial, because you will have your financial data. You just need to multiply it with the relevant emission factor, and you will get your total emissions. However, the activity-based approach is a little bit core and a little bit exhaustive process, because here you're going to engage your suppliers, and you are going to get the actual direct data from the suppliers and calculate the emissions, and this has higher accuracy with rather than your spend-based approach. And then there is the hybrid approach, which you can use for both the categories together, and you can calculate your emissions. So here now I have listed down all these scope 3 categories in a really insightful manner. So this is a case I've taken for a steel manufacturing company. I will give a couple of minutes for all of you to go through it. I will also read this after you all are done. Let me know when you're done. I'll give like 30-40 seconds. Then we can go ahead with it. So I'll also read this as you are reading. So there's a company, there's a steel manufacturing company, XYZ, and it has one integrated steel plant. And it sources raw materials like iron ore, limestone, and um, other elements. But during a recent expansion, it installed a new blast furnace and some heavy industrial equipment. They use coal, diesel, electricity in their on-site operations. Raw material and spare parts are delivered over long distances by rail and road. The plant generates operational waste such as slag and dust, which is managed by third-party waste handlers. Senior staff travels frequently for business travels and company-related events, and over 1,200 employees travel daily to office using their personal vehicles or company-arranged buses. The company leases machineries like forklifts and generators during maintenance and shutdowns, operated on-site by vendors. And XYZ supplies finished steel to customers nationwide, who often process the material through energy-intensive fabrication. While steel itself doesn't emit during use, downstream applications can involve emission. At end of life, a majority of the steel is recycled through though some is landfilled or informally discarded. Additionally, XYZ company leases warehouses, in which 4 is taken on lease and 1 is given out on lease, each contributing to its value chain emissions. So overall, this is the case which I have mentioned. Now we are going to look into the specific categories of scope 3, and we are going to see from this example how we relate to it. So the first category of scope 3 is your purchase goods and services. Purchase goods and services are your emissions occurring from your raw material extraction, your production of goods and services that a company purchases. It includes all your raw materials, components, services. So it includes all your tangibles and your intangibles in the company's operations. In the example which we are talking about, here the company XYZ purchased iron ore, lime steels, ferroalloys, refractory bricks, and electrodes. So these come under your purchase goods and services. If it had got more, if there were more in place, then we would have added to it. In capital goods we are basically your long-term fixed assets which are purchased by the company in that current financial year, and they are fixed assets. They are treated as plant, property, and equipment. So in our example, as XYZ company expanded its business, it bought a blast furnace and some other heavy industrial equipment. So those come under your capital goods. Those are fixed assets which the company uses, which has a long-term value. Now, I have put in a question here. For as we saw what are purchase goods and services. So which of the following purchases would be included under scope 3 for a consulting firm? The options are laptops and office furniture. B is cloud storage subscriptions. C is electricity consumed at the office. Or D is catering services for employee events. This is a multiple choice questions. It is open for all to answer. I would want some responses in the chat box if you are all listening. We can give a couple of minutes here. Okay, sorry, there were responses. A, B, and D. It's a multiple choice question. Yeah, you can have more options. A, B, and D. A, B, and D. Yeah, I hear a lot of A, B, and D. So sorry, I'm having some issue with. Just a minute. Rasidul, is it okay if you can present the screen, because I think my screen is having some issues.
Yes, sir. Give me a second.
So sorry about this. Are you presenting? Let me try again. I think, is it visible now?
Yes, Olivia, it is.
Yeah, so as you all answered it perfectly, it is A, B, and D, which are laptops, office furnitures, your cloud storage subscriptions, and catering services, because purchase goods and services. Electricity consumed at the office will not come under scope 3, it will come under scope 2. So perfect. Really good. This is the second question. Under capital goods, what would qualify under capital goods for a IT company? A, B, C, and D. Again, a multiple choice. B and C. B, C, B, C, and D. Let's see. And so I use the screen frequently. Yeah, the answer is B and C. I'm sorry, I'm having some issue with. Yeah, the answer is B and C, which was correctly mentioned by most of you, which are servers installed in the data center and laptops, which are a asset to a company. Moving on, this is your third category under scope 3, which is your fuel and energy related emissions, not included under your scope 1 and 2. So this is a interesting category because this actually covers the entire full life cycle of a fuel. So here we talk about something called well to tank emissions, which are whatever the fuels you are using in your company, the emissions which are generated in the production of in the generation of that fuel. So starting from your refining of that fuel, the extraction of that fuel, the transportation of the fuel, everything comes under this category. So how the fuel was created, this is what accounts for your well to tank emissions, and this all these emission factors are also there in your IPCC and DEFRA, like WTT emission factors. So here the fuel which you are using, either fuel or electricity, you're going to multiply it with the WTT emission factors and you're going to get your category 3 emissions. So in our example, as I mentioned, the steel company uses coal in its blast furnace, uses diesel in its diesel generators, and electricity in for its electricity consumption. So all these fuels you will have to account for their well to tank emissions. Moving on. Yeah. One second. Just a minute. Just give me a couple of minutes. Sorry, just give me 1 minute.
Olivia, I think I've shared my screen.
Oh, you have shared your screen? Could you go to that slide? We're talking about well to tank emissions. Right, we covered this. Moving on to the next slide. Yeah. Here we are going to talk about your upstream transportation and distribution and your downstream transportation and distribution. Emissions occurring from those two categories, which are your category 4 and category 9. So emissions from the transportation of your of all the inputs, raw materials to your facilities, all the emissions that are coming from that logistics, either they are third party owned or some from other vendors, all these comes under your upstream transportation distribution. And for downstream, emissions coming from the transportation of your sold products to your final consumers. It includes your warehousing and your retail distributions. All those categories will come under your downstream transportation distribution. Moving on. This is the fifth category, which is your waste generated in operations. So now we were looking at everything with respect to energy and emissions. Now this is something which is different. This is a waste category, and this is specifically your operational waste. This does not include your packaging waste or end of life waste. This is just your operational waste. So emissions from your treatment of your waste generated in the operations, those come under this category. Either if it is sent to landfill or it is incinerated, those emissions account and come under this category. So in our example, which we are looking at, the steel manufacturing company, there was a mention of slag and dust sent to landfill. So emissions coming from that will account in your category 5, which is your waste generated in operations. Moving ahead, we have category 6 and category 7. 6 is your business travel and 7 is your employee commuting. This is a very common category which companies usually go for when they're starting off with their scope 3 accounting, because this is because you can get the data easily and it can be calculated. So business travel is all your emissions coming from your employees going to your business activity. Sorry, I'm so sorry. So business travel emissions come from all the travel and travel emissions which employees, when they travel from one place to another due to any business related activity. So it can be an air travel, it can be a land travel, it can be a sea travel. All those emissions come under your business travel. What if they are going for the business related activity? Your employee commuting is your emissions coming from daily commutes of employee back and forth to your office. So in our example, as we saw, over 1,200 employees travel to work daily via bus, auto, or personal car. So this will come under your employee commuting, which is your scopes, which is your category 7 category under your scope 3. Moving ahead, I think we have a quiz for this. Yes. So under business travel, which of these travel related emissions count? Flights to attend client meetings, taxis used during business travels, daily office commute, or hotel stays during conferences. Again, this is a multiple choice question, so you can have a lot of options for this. A, B, and D. I see a lot of A, B, and D. Perfect. I think we have got like 10 plus responses in this. So it is A, B, and D, which is flights to attend your client meetings, which will come under your business travel, taxis used for your business activities, and of course your hotel stays during any conference. Your daily commute would come under your employee commuting, which is your category 7 of scope 3. Yeah. So this is the second question which we have. What data would be needed to calculate emissions from commuting? Average one-way distance, type of vehicle used, number of work days, hotel stays. This is for employee commuting. A, B, and C, all. A, B, and C. Perfect. It is A, B, and C. Your average one-way distance, either that or your type of vehicle used, and number of work days traveled by that employee. Perfect. Moving on. Yeah. So this I have clubbed it down as leased assets. So this is your upstream leased assets and your downstream leased assets, which is category 8 and category 13. So upstream leased assets is all the emissions coming from assets which the company takes on lease. In our example of the steel manufacturing company, it leases machineries like forklifts and generators, and it has 4 warehouses which it takes on lease. So it has to account for those emissions, and that will come under your upstream. Under your downstream, the emissions coming from assets that the company gives on lease. So here in our example, we saw it owns 5 warehouses, but it leases out 1. So your emissions coming from that warehouse will have to be accounted under your downstream leased assets. So moving ahead, here we have a question on upstream leased assets. Which of the following leased assets would fall under the category? Rented office printers, leased laptops used by remote employees, buildings owned by companies, or shared cloud services access. Which one do you think would come under upstream leased assets for a company? Perfect. I see a couple of responses, A, B, and D. A, B. Correct. Rascal, if you can move to the next slide. Yeah, it is AB, which is rented office printers, your leased laptops which are given to your remote employees. Your buildings owned will not come under your upstream leased assets, and shared cloud access will also not come under your upstream leased assets. Moving on. Yeah, so now we're going to talk about category 10, 11, and 12 downstream emissions of your scope 3, which can be clubbed entirely as your product life cycle. So category 10 is your processing of sold products. Here, it accounts for emissions from processing of the sold products, which act as intermediate product for other industries. Say, for example, I'm just giving an example of a dairy company. So if the dairy company sells milk, so that milk is further used for the processing of butter. So it acts as an intermediate product for the other company. So it has to account for that emission as well. In our example of a steel manufacturing company, the steel which it produces, it is used as parts for different automobile companies. So then we would have to account for the emissions which that steel is producing. The second category is use of sold products. So here emissions come from the actual use of sold products, and here we mainly look at energy consuming products. So if steel is being used in buildings requiring energy for maintenance, then it will come under that category. However, this also depends on your product and your sector. It is not applicable for all, but these are the categories which are listed. Moving on, we have category 12, which is end of life treatment of your sold products. So here emissions coming from your product disposal, either your landfilling, recycling, or some other methods of disposal, emissions coming from those will have to account for end of life treatment. So if you are, if the steel manufacturing company which we're talking about recycles 90% and sends 10% of to landfill, then it has to account for those percentage of emissions. Moving on. This is the final clubbed category, which is your business model emissions. Here you have category 14 and category 15. 14 is your franchises and 15 is your investments. So this is also very specific. If you own any if you have any franchised outlets but not directly owned, that will come under this category. And under investments, if you have investments in some portfolio or some other companies, you will have to account for those emissions. Again, this would be applicable to you if it is relevant to your sector. Moving on. Here I've kept an example of how do we calculate our emissions. Very simple calculations I've kept for our scope 6, our category 6 and category 7, which is our business travels and employee commuting. So here for employee commuting, if they are traveling via cars which are driven by petrol, number of employees is 100. Your average daily round trip is 20 kilometers. Your working days in a year is 220. So your emission factor, which is taken from DEFRA, is 0.18. And you are going to multiply your total number of employees, your kilometer traveled, and your working days, and with the emission factor, and you're going to get your total emissions from your employee commuting category. The second scenario is business travels for any business related activity. Here the distance travel is 50,000 kilometer. Emission factor taken from DEFRA is 0.27, and that is just calculated by simply multiplying it. We get as 13,500 kg CO2 equivalent or 13.5 tons CO2 equivalent. Simple calculations can be done, and you can even use tools for your calculations, but understanding where the emission sources categorized in different categories is really important. Calculations can be done using different tools and softwares as well. Moving ahead, here I've mentioned as to finally wrap up the session by understanding what are the few challenges we face while we start our scope 3 emissions accounting. First of all is data availability is very, very poor, especially if you're going ahead with your activity-based approach, where you will have to engage your suppliers. It is difficult to navigate through your value chain because of lack of awareness and lack of data availability. The second thing is boundaries are sometimes unclear. We are not very sure what entities are we looking into. Are we looking at national boundaries or international boundaries? So boundary setting is also something which is very important. Then emission factors are sometimes outdated and are regionally mismatched. Maybe you have suppliers sitting at different countries, at different regions. Then you will have to account for the emission factors in the specific region. So that is also a complex task. Then, as I mentioned, suppliers do lack awareness about the basic understanding of ESG, and sometimes they do find it difficult to help the company in their scope 3 accounting. Then the method selection is, of course, very tricky. No one size fits all approach is applicable. You will have to either go for a hybrid approach where you're using both spend and activity based because of lack of proper available data. Then there's also a matter of lack of proper SMEs in the sector. Verification and auditing your scope 3 data is also very difficult because lack of subject matter expertise in the field. Then standardization becomes a challenge here because scope 3 emissions are very sector specific. It is difficult to standardize it and have one framework have one guidelines which will fit all the sectors and all the companies. So it has to be customized accordingly, and that becomes a challenge sometimes. However, it is having all these challenges, but it is really, really very important to start accounting and measuring your scope 3 emissions, because finally it is the only way of getting a proper and total picture of your entire GHG emissions. Because if you're not looking into your scope 3 emissions, you are neglecting and ignoring almost 50, 60, 70% of your total emissions. So it's really important to start with the journey. Definitely challenges will come in the face, but as you are maturing as a company, you will definitely find a better way to go about it. Moving on. So here I've just kept a slide to summarize what we have talked about in the entire webinar. So we looked at scope 3 emissions importance, relevance, why are we even talking about it, and why is it so important to look into your scope 3 emissions. We looked into what are upstream and downstream emissions under scope 3. We saw all the steps to calculate our scope 3 emissions. We went through our entire 15 categories of scope 3 spread across upstream and downstream. We looked at a manufacturing company example of a steel company and how scope 3 categories are relevant, which scope 3 categories are relevant, and where it will place for a steel manufacturing company. We also saw a couple of examples through polls. We tried to understand that better. And finally, we saw what are the challenges which currently companies face while they do their scope 3 emissions calculations. So yes, that has been the gist of the entire webinar. Open to questions. I think we are good in time.
Thank you, Olivia. Thank you so much.